Planning for college can feel like putting together a giant puzzle, especially when it comes to figuring out how to pay for it all. Many families find themselves needing a little extra support beyond grants and scholarships, and that is where student loans often come into play. When you are looking at student loans, the main types you will compare fall into two big categories: federal student loans and private student loans. Each category has different options, features, and benefits that are important to understand for your financial future. The fundamental difference between federal and private loans comes from who provides the money. Federal student loans are funded by the United States government and come with a standard set of terms and protections. Private student loans, on the other hand, are offered by banks, credit unions, and other financial institutions, and their terms can vary widely. Within the federal loan family, you will encounter direct subsidized loans, direct unsubsidized loans, and plus loans. Subsidized loans are fantastic because the government pays the interest while you are in school at least half-time, during your grace period, and during deferment. Unsubsidized loans accrue interest from the moment they are disbursed, but they are available regardless of financial need. Plus loans are designed for graduate students or parents of dependent undergraduate students. These differences in interest accumulation and eligibility are key to their value. Private loans generally have interest rates and repayment terms that depend on your credit score and financial history. This means you might need a cosigner if you do not have an established credit history, and the rates can be variable, meaning they change over time, or fixed, remaining the same for the life of the loan. Federal loans usually have fixed interest rates and do not requiring a credit check for most undergraduate students. To make the best choice for you, start by always maximizing federal loan options first. They typically offer more borrower protections like income-driven repayment plans and opportunities for deferment or forbearance if you face financial hardship after graduation. Then, if you still need additional funding, carefully research private loan providers, comparing their interest rates, fees, and repayment terms. Look closely at whether the interest rate is fixed or variable, and understand any prepayment penalties. Remember, federal student loans also have annual and aggregate borrowing limits, whereas private loan limits are usually based on your cost of attendance minus other aid. Thinking strategically about these limits, along with potential future income, can guide your borrowing decisions. For example, federal loans often include Public Service Loan Forgiveness, or PSLF, which is a program that might forgive your remaining loan balance if you work for a qualifying employer after making a certain number of payments. Ultimately, understanding the distinctions between federal and private student loans and their respective subtypes empowers you to make informed decisions that support your educational goals while minimizing your future financial burden. By prioritizing federal aid and carefully scrutinizing private loan details, you can secure the funding you need with confidence and clarity.